financial markets, patterns are everywhere. However, not every pattern really matters. Only the patterns that can be turned into performance you want to focus on, right? And today, what I would like to do, what I would like to show you, is how Robeco systematically identifies, analyzes, but also transforms hundreds of these type of patterns into signals, into an investment process that's very disciplined and that has yielded, since we started in 2004, very significant, strong and stable risk-adjusted returns. And these returns are not there because we chase the latest market noise. No, we're not doing that. The returns are there because we uncover those patterns that endure and are manifesting themselves in developed anti-merger markets. And there's something very powerful about these patterns if you follow them, right? Because if you follow patterns that work, what happens is that performance compounds. And if performance compounds, trust compounds. And if trust compounds, assets compound. So we started in 2004 with our first little, although it was a few €100 million, I have to say, mandate for a Dutch institutional investor that believed in this concept of capturing patterns and turn them into performance. And now fast forward to today, quant investing has grown significantly. It's one of the largest capabilities at Robeco, and especially within the quant space, Ray was already referring to it, enhanced indexing has been a very clear growing asset category for us. So enhanced indexing, what is that exactly? Well, I believe many of you know it, so I will really briefly give you a refresher what we believe that enhanced indexing is. We all know the success of passive, but in our humble opinion, you can do better, right? So passive investing to us is, great. It gives you access to very diversified portfolios, available at very low cost, highly liquid as well. All great, and we basically tick the same boxes. We also build very well diversified portfolios available at relatively low cost. But passive is passive. You just replicate an index. You don't use any IP, any knowledge. And in today's world, with all this knowledge that we have already for decades, it's a bit of a pity that you don't use it to your own advantage, especially if you're a long-term investor. So what we do is that we're not replicating an index. No, we just look at all the constituents in an index. We judge them on their alpha capability. So do you want to own them a little bit more for the next 9 to 12 months, or maybe slightly less? So we basically tilt that portfolio, that index, towards a more enhanced index. And along the way, why only focus on alpha when you can also integrate with massive amounts of data sets, sustainability dimensions? So that's what we're doing. And that's what we're doing also for Curate. In the enhanced indexing portfolios, we lower the carbon footprint by 30%. We lower the sustainability risk by 10% and also focus on water and waste reduction. And at the same time, give access to alpha. Right, so that's basically, in a nutshell, in a minute or so, what the concept of enhanced indexing is. And why does this work? Well, it's the power of repetition. So if you rebalance such a portfolio every month, then performance will compound, and then you get a better return, basically, than a pure passive portfolio. So what is behind enhanced indexing? Is it that we basically judge the market in a good way, make a big call on a certain region, right? US or not, maybe not today, right? Or certain sectors? No, these are many, many trades that we're doing. So in fact, our longest running strategy, where all the Robeco employees are invested in, our pension money, we calculated that we've done over 20,000 different trades. So all these little trades compound and deliver the alpha. But I have to be fair, is this really the root of the alpha? Is this really, the reason that it creates it? No, we do transactions, buying and selling. And we do this transaction because an algorithm tells us, based on a lot of signals, and signals are just patterns put in some, quantitative language, they show us that there's alpha. But what is creating these patterns that we try to turn into performance? Well, ladies and gentlemen, that's us. That's you and me acting on the stock market. Because these financial markets that give us performance patterns, they exist because human behavior hasn't changed in 1,000 years. Whether we like it or not, emotions, behavioral biases, opinions, they influence our decision making, right? And not only the retail investor, no. Also professional investors have their emotions and take them to work. So what's the best way to deal with all these emotions? Well, of course, as an investor, you need to keep them at bay. Preferably you don't take them to work, of course, but yeah, we're human beings, right? So you integrate them and they're part of your conscious decision making, right? Or subconscious decision making. So the best way to deal with this basically is to use an algorithm, a computer, a systematic approach. In other words, a kind of more a robotic type of targeting these type of signals. I'd like to stress to you that an algorithm approach can be very helpful because try to perform as an analyst 2,000 calculations in a few seconds. It's virtually impossible, right? Try to read 10,000 analyst reports before lunch. Impossible. Machines can do that. They work day and night. They don't complain. They don't ask for salary increases every year. So, from that perspective, I think Karen agrees with me. It's quite a nice approach. But I'd like to stress here that it's not human versus machine. Totally not. Because I will show you also in a minute that at the end of the day, you still need humans to come up with ideas. Even in the age of ChatGPT, AI tools, you still need humans to come up with the ideas, to really execute the research. And also, when you come across clear signals and you want to implement them in portfolios, also a portfolio manager, it's very helpful that a human being makes a judgment call because the computer can't always make the best judgment call at all. So human to machine is our approach here. And maybe it's good that I shed a little bit of light on these type of signals that we're using, because yeah, we've turned over the 2 decades that we have live performance. We turned many of these patterns into signals, and we give clients basically access to these signals. And yes, I'm Dutch, so of course we love value, like a lot of other humans, buying things, on the cheap, buying a dollar for 50 cents. It's a concept, that's a pattern that has proven its value over and over again. And as you can see in this overview, a lot of these signals are orbiting around the concept of value investing. So we look at indeed balance sheet data, also, of course, income statement data, but more importantly, we look a lot to the intangible data because, in this new era where we're living in with asset-light companies, good luck with only focusing on real balance sheet numbers. So we love value, but maybe even more, we like quality. We like firms that have very strong management that carefully looks after the interests of their shareholders and are able to grow their earnings over time. And something I believe that really stands out for Robeco in the way that we capture quality is that we don't only look at the hard yardsticks, like, for example, accruals ratios or top line earnings or what have you, right? No, we found out that especially the sustainability related quality signals hold a lot of power, right? So looking more at the softer components of a firm, how happy are your employees? How are you dealing with your carbon in your company, with your reinvestment in your machinery? These hold valuable signals as well for us that we classify as quality. And these are just few examples because Ray was already mentioned it, a few factors, and I thought for a second, oh, there goes my story, but luckily there's still more time for me, Ray. We have many signals residing in these various factor groups. So yes, we like firms that are trading below intrinsic value and that give access to high quality management. But you can find these companies, but yeah, you need money in motion. There needs to be a catalyst to unlock it, because otherwise your money is really not accumulating. And therefore we have momentum. Momentum as a factor, but also analyst revisions and more shorter term signals. But this is just what you see if you look at the fact sheets, at all the materials. But today I promise you to dive a little bit deeper and tell you more about the process behind the construction of these signals. So here we go. How does it start at Robeco? Well, first of all, it starts with IG generation. And yes, we have a quite sizable quant research team. We have the largest quant manager in Europe, so over 25 different quant researchers. But more importantly, and I'd really like to stress that here today, is that Robeco gives home to some 60 professionals working in our very successful fundamental capabilities. And that's special. That you are a quant manager and that you have access on the same floor to fundamental portfolio managers. And why is it special? Because a lot of ideas that we as quant integrate in our models, we get them by talking to our colleagues at the coffee machine, organized meetings. But nothing beats sitting down with an analyst who covers, for example, Brazilian mining stocks and ask her how does he exactly capture the mode of such a company. Many ideas that we have put to work in our portfolios are there due to the strong collaboration. So quant, yes, you can do that, it works, but you need also good fundamental people for that IG generation. And in total, yeah, you can see we have some 100 research IDs. So next step, what you need to do, because yeah, we don't have unlimited manpower, you need to, of course, prioritize. We need to set a very clear research agenda, which IDs we want to execute and which one we maybe need to park, right? So we do this every year. And the beauty of this approach also is that you don't, let your mood of the market influence your research decisions. No, we really deliberately set a clear research agenda that sets us away from the noise in the daily markets. That helps a lot. And then next, if it's up high on the research agenda, we need to start executing. So the first step that we're doing is a bit of exploratory research. We put a lot of researchers in a room. It's free format brainstorming. We basically try to assess how we could tackle a certain research idea in the most efficient shape and form by looking at academic publications, signals that we may have already, experiences of fundamental managers as well. And basically, that gives us a very good understanding of how we should address certain things and how we basically should capture this idea. And that's important because if you take the wrong avenue, well, you're going to spend a lot of research hours and maybe even your weekends to get to a very good signal. So, but once we have these hypotheses formulated, we know a little bit where to look, then we go to the next stage. And that's a very important stage for any quant manager. So if you look to quant managers, really assess them how good their infrastructure is, because especially nowadays, in the age of AI, where there are large data sets, which are sometimes 20 to 4 times bigger than the data sets that we had 5 years ago, it means you need to have a very good, strong cloud-based, AI-ready infrastructure. So back in the days when we started, we did our research on those mainframes, right? Pentium PCs. And then later, of course, we upgraded and we had more fancy, better laptops. And nowadays, thanks to a migration that we did some 5 to 6 years ago, everything is cloud-based. And that's blessed for researchers because it means that you can just upload your IDs, you test them, and in a few minutes, you have your output instead of a few days. So you can imagine that currently a researcher at Robeco has 4 times higher output than they used to have, let's say, 7 years ago, which is magic if you have a lot of research IDs, of course. And this is also important if we connect later AI, but I will give you an example later. Next step in the whole process is that we, of course, need to test IDs. And the beauty, I would say, of our approach is that we not only test data on the US market, it's a bit of standard for quant managers because data is very much available for US markets. It's also relatively cheap. But if you only see an effect working in the US market, but not for European or emerging markets, well, good luck with your alpha signals. Probably not there, your data mining. So therefore, all our IDs, we test them both in developed and emerging markets. And they need to work in both markets. If not, we just skip it. We start all over again. We basically look at a different signal. At the end of the day, after all these signals are tested, all the research is done, then we have a committee of very senior portfolio managers, researchers, heads of research that look into the entire research process, challenge people also in the outcomes. And the next, basically, we go to the next step. We want to implement it. But let me pause here because it maybe gives, a bit of an impression that this is a very smooth process. The process is smooth and that the outcomes are always perfect, but reality is a bit different. I can tell you that. Life of a researcher is not always nice. And here I can explain you or show you why that's the case. We have many ideas, and sometimes we really think, whoa, this is a bright idea. If you're going to test it, you will see the alpha there. And then what happens? The signal ends up in this signal graveyard. We thought it was a brilliant idea, but we don't see the alpha. Then we need to give it up. Other signals, they might look good, but the coverage might be not that well. What we do next is that we don't put them in the models, of course. No, we put them in the cellar or the fridge, whatever you want to call it. Because basically it needs a little bit more, few years to get better coverage and maybe get our hands around it. So ultimately, only 15% of the IDs make it to our models. That's our hit ratio, and we're quite proud of it. In fact, we celebrate our funerals, you could argue, because at least there was a good attempt and a good ID. So here it is. This is basically the entire overview of the investment process behind it, the real ID generation that we're doing there. If everything looks smooth, we implement it in our models. So in a nutshell, and also to summarize it, this is the entire overview that has delivered us the alpha over the years. All the research that is going on that you don't see if you look at a fact sheet, but it's basically the work of an analyst, of a researcher, and a portfolio manager, thanks to this collaboration that we have with our colleagues in the fundamental team as well. But this is very theoretical, I realize. So nothing beats, I would say, a very good real life example. So I would like to give such an example and share that with you. I put on here a price chart. Maybe somebody already sees which stock it is. It's a stock related to AI. You know, they produce chips, very popular CAO as well. It's NVIDIA, of course, right? And what you see here is a classical chart formation, you would say, right? There's an uptrend and there's suddenly a dip. And the 100 million question or 1 million question, of course, is should you buy the dip or not? Well, an economist might say, well, it depends, right? And nowadays we also say that. But back in the days, our research and also academic research basically said, look, if you see a stock dipping, so there's really an uptrend and suddenly a price reversal, in some 60 to 70% of the cases, it's okay to buy the dip because the stock tends to bounce back. Well, fast forward to back a few years, we had a and he's still around, bright researcher that said, well, this concept works. It delivered money to our clients, but can't we do it better? Because we now have a very new AI infrastructure ready online platform to test our IDs. And we thought, well, can't we connect this signal to news in the market? So in other words, the hypothesis was, well, if, the stock is dipping, right, in the uptrend and there's good news, it probably, you really need to buy it. And the idea, of course, if there's bad news, you maybe want to stay out of trouble and you may not want to touch that type of stock. And to be fair, we didn't know what the effect would be if there was no news at all. So this was the IDs, and IDs are always simple. The execution is way harder. And for us, it also took some time because, what the big drawback is of news articles, and you can see it if you just get a newspaper or go online to a news website, is that there's always a headline and there's always a story, but unfortunately, it's never tagged like, oh, this is a good story. This is a bad story, right? So, and we needed to connect 10,000 stocks to news sentiment. So long story short, we basically developed our own large language model that basically tries to identify whether a news story is good or bad. And then next, after we've done that, we connected that to the price information of stocks. So fast forward to today, how does this help us? Well, nowadays, yes, we look at the dip, we see that this company is maybe retracing in price, but then we make a judgment call based on also the new sentiment. And the most interesting fact that I'd like to share with you is that, yes, buying the dip when there's good news, formula for success. Staying away when there's bad news, good idea. But if there's no news, then we saw the most powerful bounces. And that got us thinking, why is that happening? A stock is suddenly going down, there's no news. Well, seems quite logical. If a stock is going down and there's no news, it means most of the time there's a forced seller. And if the seller is done selling or multiple forced sellers, right, especially in smaller cap stocks, you observe this, then the bounce is very much more profound to the upside. So nowadays, we augment large data sets thanks to large language models that are driven by alternative data sets, so to speak, AI type of signals with existing well-working signals, and we basically get more alpha out of a signal. So that's, a very clear example how we use this in practice. And if people ask me, well, what's your formula to get there? And the only thing I can say is not only show the code, right? Because it won't tell much, but it's basically this process behind it that gets us over and over again these type of new insights. And mind you, this is not easy to do. Of course, you need to have good researchers, but you also should be able to have a very big team that can really spend a lot of time performing these type of analytic exercises. In fact, some 2,000 hours of manpower, human power, we have spent on this project to get it off the ground. And that may sound impressive, and it actually is, I think, but yeah, it's only this signal that we're having here, what I just discussed, is only one of the tiny signals that we have in our models. We have over 50 different signals in the enhanced indexing portfolio that all contribute a little bit to the excess return that we're generating for our clients. So if you think of that, all that work for just the enhancement of one signal, while we also have all the other signals and sum it together, with all the other factors that we have, and their signals are orbiting around that concept, you can understand how massive this operation is. But at the same time, having 50 signals also drives this diversification, and that leads, of course, that we can turn these patterns into performance. Because that's what we have been doing over the years, and we're very fortunate that we can partner with Curate. We started on this journey a few years ago, and here you see the results of the Global Sustainable Equities Fund, where we, of course, with a very low tracking error of a little bit of over 1%, target an excess return and sustainability dimensions. So you get both, right? And you can see that since inception, the performance has been decent. We're very happy with the performance that we delivered, and also the partnership with Curate, and the fact that they deliver to your clients basically a better core allocation than just simply buying a passive or investing in a passive strategy. Not only in global markets, but these models, as said, also work in emerging markets, and these results also speak for themselves. Since inception, we managed to deliver 2% excess return with a very low tracking error. So no big bets in the portfolio, stay very close to the benchmark, repeat this process all over again, and then you turn patterns into performance. I would like to thank you for this presentation. Thank you, Ray.
Thank you. And thank you very much. In fact, what we've started seeing, and I'm glad you ended with the emerging markets fund slide. What we've started seeing is, as Sinisha spoke about, a shift from the large, older, I suppose, large powers to the more emerging market space. The risk and the fear of most clients is that the passive element of it is very volatile, very risky. And when they look at accessing the emerging markets, we've seen a lot of demand for the Curate Global Emerging Market Fund. How does your process, the enhanced indexation, give people a little more reassurance about the volatility in an emerging market fund like that?
Yeah, so the excellent question. Thanks for that. So the beta of the portfolios is 1. So we have the same level of volatility, but from a more, I would say, diversification perspective, you need to have emerging markets exposure, right? Not only because the long-term prospects are way better than the current developed markets, but I think also, and that's what we share with a lot of clients, is say, well, if you just have a passive allocation, you only get the beta return and you have the volatility. Or you could choose from getting the beta plus excess return and having the volatility. You can at least pocket some excess return while the markets remain volatile. And we've seen that our models work very well in emerging markets, in fact, even better than in developed markets. And it has to do with the fact that, the US, up till now, at least, is moving in lockstep with Europe. So, it's quite a homogeneous signals that you get out of it. But the economy and the stock market of South Africa behaves completely different than the stock market of Brazil. And we're 100% bottom-up stock selectors.
Yeah.
So we just enjoy more the benefits of this diversification as well.
Okay.
Yeah.
I've got one from the audience, and it's linked to actually what some of the stuff that Karen was saying in terms of know who you are and stick to your knitting. The question says, many factors go through long periods of underperformance. How does Robeco decide when to stay disciplined versus when a pattern may have structurally broken down?
Yeah, it's the most important question. It's another $1 million question, I would say. It's super important, and it's super important to stay on your course, right? So therefore, we have this research agenda. And for us, it all starts, all this research, with a very clear economic rationale, right? So if somebody has an idea, but it doesn't make any sense, or we cannot connect it to some kind of economic theme, then we're not even pursuing this whole exercise, right? It needs to have a clear economic rationale. So if a factor is underperforming, can happen, right? It's a fact of life. Therefore, we diversified. And what we do is we first check whether that economic rationale is still valid. And if it's still valid, we still keep it in our models. Because the worst thing you can do as a quant manager or any investor is, after you designed your process and it's working, and then after a stretch of headwinds, a little bit of underperformance, change your models. If you do that, that's human behavior, emotionally driven mostly, and we know these outcomes are not the best. So we stay on the course, we execute a research agenda, we keep on enhancing variables, we communicate even more with our clients on the performance, but that's the only way that you can survive. And I think these 20 years track record have also proven that approach yields good value.
I'll give you one last one.
Yeah.
It's actually quite an interesting one. It says, in your conversation, you spoke about adding signals to your
Yeah.
process. And it says, have you removed any signals or do you just carry on adding as explained in your process?
Yeah, we've moved signals, not many. Sometimes you have a change in accounting legislation that makes that a variable, doesn't make any sense anymore from an economic perspective. Then we remove it. Sometimes we perform research and we stumble upon a very good, strong signal with way better coverage. And then we run so-called spanning alpha tests. So the jargon for looking for the same pattern, whether you already have that in your models. And sometimes we like to make things as simple as possible and only as complex as needed, because we want to have full control over this process. And sometimes we come up to the conclusion that we can take out two variables and replace it by one better one, right? And that gives us also then a better risk control. So it happens, but not many times. I think maybe once every 3 years or something like that.
Perfect. Thank you. Thanks very much, Jan.
Thank you.
Yeah.